Well, thank you, Anthony. Actually, I was hoping you were going to let me sit in that chair because, you know, Anthony's been sitting in that chair as the moderator all morning. Very comfortable, but I thought I would be enlightened with some wisdom if I was able to sit in that chair. But I think you know, all know Anthony Belchambers, who's Chief Executive of the Futures and Options Association and our primary moderator for most of the morning. Michael Hofmann, who's the Managing Director with ABN and AMRO, and I think Michael and I go back probably longer than I go back with Clive Furness for that matter. And then we have Nathalie Gallant, who is the Executive Assistant in the Enforcement Division of AMF something in Quebec. You have to tell me what AMF stands for, Nathalie.
It's actually French for Autorité des Marchés Financiers, but we say Quebec because people tend to mix it up with AMF France. So.
But Nathalie is, of course, the regulator on the panel. As I say, Enforcement Division sounds very ominous, but I promised Nathalie that even though we've all been complaining about regulation in the marketplace all morning long, that we'll be kind to her through the course of this panel. But let's start out. Anthony, I feel as though all I have to do with you is just say go, and you'll enlighten us with everything.
I will behave myself. Trust me.
With everything that we want to know. But let's start out with some of the key regulatory issues. I mean, I hear all these terms, whether it's dodd-frank, whether it's AMRO, whether it's MiFID, and for most of us, it's just kind of this hazy cloud with a myriad of regulation. And maybe you can start out by trying to make some sense out of what's going on for us, and perhaps most importantly, there's some differences. There's some similarities and some differences, I think, in the direction all this regulation is moving.
I think, look, to summarize all those directives in a very short period of time is very useful, and I realize other panelists have got things to say. What I would say is I personally believe that the EU started off in a better way with this. I think they consulted more to start with before they put pen to paper, which is why the legislative process here takes longer. And don't forget, you know, we've got, 50 political parties and 27 governments. It's a lot more complex in Europe than it is, dare I say, in the US and certain other areas. What are we trying to do? We are trying to, this is basically a program of regulatory repair where there is not a lot of tolerance to the economic argument. And there's not a lot of tolerance to, this is going to cost a lot of money, have we got the balance right? Because at the end of the day, if you engage in regulatory repair as envisaged by these directives and regulations, it is going to cost more money, and I think everyone has to face up to that fact. The question is it going to cost so much money that it's going to disturb the underlying economics of the marketplace? That's the fundamental question that has not yet been answered by anybody, frankly. And I realize doing a cost-benefit analysis across the whole piece is extremely difficult to do. It's not an easy thing to do. But what we're doing here, it's really important that somebody has a go at it rather more seriously than to date. So I think that's the first question. In terms of differences, all I would say is there are probably, there are many that I haven't identified, but about 15 fairly fundamental differences between the approach in the EU and the approach in the US. We've touched on a couple of them this morning. There are plenty of others about the scope of regulation applying to end users, where some of them will be captured as swaps market participants or swaps dealers. In the EU, for example, there will be no change in the basis of authorization, whereas in the US they're drifting a bit towards an exposure size test. If you have huge exposures in the market, we may elect to regulate you directly, and that has a huge cost, both in terms of prudential regulation and business conduct. There are a number of other differences. All I would say, and then I really will stop, is just one needs to bear in mind, I think, that while the international standard setters have set the parameters for how we regulate and the basis on which we introduce this regulatory repair program, everyone is cherry-picking those standards a bit. There's no question of that. They'll say, well, we like those 10. I'm not sure we like that one, so we may not go that one. And the other thing to bear in mind, apart from that, is when you get down into the depths of all of this stuff, you do find some pretty big differences beginning to emerge. Now, there's a great attempt between the EU and the US to reconcile all these differences, but some of them are red line differences that won't be For example, the 20% cap on bank ownership of market infrastructures. We don't have that in the EU. I mean, and there are many others like that that may count for something, and the extraterritoriality on both sides is going to create high amounts of legal risk and compliance complexity around cross-border business. Stop there.
Michael, how about from a practitioner's point of view? Do you have some observations as to what's happening?
The little I understand, yes.
I thought you would.
I think the easiest way of doing it is just me reading off just a brief little thing I wrote here, which more or less sums up my personal view. The onslaught of recent impending and threatened regulation paradoxically bears in itself a significant risk for the industry and end users. It is not only the individual regulatory plans and proposals that create this very real risk, more so the aggregate total of regulation that is on its way, as Anthony already pointed out. Too many surgeons performing parallel operations on one patient at the same time. The future of Europe as a center of market liquidity and investment, also for those that purchase government debt, i.e. the Volcker Rule, is at stake. Europe, and to a certain extent the US, is risking its attractiveness as a place to invest capital. Vast sums will continue to migrate east, as will trading firms. We're seeing that trend already today, also amongst our client base. Some oncoming regulation is even contradictory, i.e. AMIR and dodd-frank. The future of Europe is the vast sums will continue to migrate east, as will trading firms. Some oncoming regulation is even contradictory and generally not coordinated between government bodies, ministries, agencies, and regulators across Europe and within the US. And that's a very disturbing observation. I was on a panel just 4 months ago, and I won't mention the name, but it was one of the executive board members of the ECB who looked at me and was very surprised that I mentioned the two words transaction taxes. And he said to me, "What do you mean transaction taxes? I thought that that topic and that issue was off the table." I said, "No, open the paper. Every week there's something on it. Every country's coming up with some sort of a new formula for transaction taxes, whether it be equities or derivatives. Damaging the U.S., damaging and confusing in any case, be it Dodd-Frank, AMIR, and I say AMIR, not AMID, because it's not a directive, MiFID II, Basel III, transaction taxes, short selling rules, high frequency deceleration, and many more such punitive measures to appease a poorly informed but scapegoat-seeking public or electoral constituency, and to demonstrate a late flurry of perhaps well-meant but not always thought through and often self-defeating activity. It is questionable whether stricter capital rules, best execution, short-selling restrictions, or transaction taxes would have and could have prevented the demise of Lehman, MF Global, prevented the financial crisis, and the European debt crisis for that matter. And I have yet to meet somebody who tells me that these rules and regulations that are on their way would have prevented that. Many of the above measures have already been tried out in different parts of the world before. Transaction taxes introduced in Sweden and Brazil quickly wiped out up to 50% of the exchange volumes. It is naive to think that market participants, especially those that do not qualify for an exemption, will tolerate and swallow a tax, no matter how small. In a world where latency is measured in milli and nanoseconds, a 1 cent tax proposed on equities is a huge amount. The business will not disappear. It will simply migrate to more attractive and welcoming locations, be it Dubai, Singapore, or other places. Regulatory arbitrage is the consequence and product of regulatory uncertainty. In the case of Germany, only 17% of the equities represented on the DAX are traded on exchange in Germany. The vast majority is traded outside the country on other exchanges, MTFs, or OTC. There's not really much left to regulate, and consequently, not much tax income to be made if the business shrinks. And we get this in Germany on TV all the time. Politicians are already rubbing their hands and calculating how much money they're going to be making on transaction taxes and other such punitive measures, But if the business is gone, then it's a zero-sum game. As is to be expected, volumes may drop substantially. When seemingly minor regulatory changes and/or taxes were imposed, the decrease in liquidity will automatically widen spreads and lead to higher transaction costs, not to mention an increase in manipulation risk potential. As usual, these will be borne by the retail clients, the same individuals that the flood of regulation is meant to protect. And just as sort of a closing sentence, as a member firm, we are confused. Dodd-Frank alone is 848 pages, okay? Now that's a hell of a lot of reading, you know, that's more than I read on vacation in the summer. Not to mention the type of literature that we're talking about. And there's a great danger, and I have yet to meet other member firms that honestly admit that they understand what is coming and that they understand what the implications are. And the implications are not just regulatory, they are also technical. There's a lot of money at stake. The business is at stake. There's a lot of investments that need to be made, and I don't think anybody has a full overview of the whole picture.
I've never known Michael to be shy about his particular point of view.
Thank you.
I also think that Michael's probably given us enough ammunition here to take up about 8 or 10 panel sessions, but we'll do our best. Nathalie, first question is, did Michael send his letter to you?
No.
He didn't.
I sent it to nobody. That was preparation.
But before we start picking on Nathalie, why don't you at least tell us what's going on in Canada?
Perfect. Well, thank you. And Fred did allude to the fact that he'll take it easy on me being a regulator and all. And please be aware that I'm probably sitting here with more questions than answers. So to my fellow panelists as well. In Canada, and as I was saying just prior to this panel starting, we're sitting over the US and on the other side of the ocean from the EU. And we're kind of in between both because our member firms in Canada have a huge arm in the US and also a deal in the EU. And as regulators in Canada, and for most people, if you're not familiar with the regulatory structure in Canada, well, it's mind-numbing. The AMF in Quebec is part of a 10-province, 3-territory Securities Commission regulator structure. We all collaborate through an umbrella organization called the CSA. And the goal is to harmonize regulations. We do talk to each other. We don't work in silos. And in this particular initiative on the OTC derivatives reform, again, we have to look into the States and read those number of pages of Dodd-Franks. We also have to look in the EU and look at what MiFID is actually bringing on. We have to understand both jurisdictions and then come up with what's actually relevant for the Canadian market. And we're not the biggest market, but our firms are very important. So just to give you an idea, we are working with the Bank of Canada, which is the central bank. We're working with the Minister of Finance. We're working through the CSA umbrella organization. We're also working with OSFI, which is the Office of Superintendent of the Financial Institutions. They actually regulate the federal regulated entities, which are most of our banks. And there's a lot of work being done. We're in the consultation process right now. There's been 4 out of 9 papers that have been published. Basically, the overall OTC derivatives regulatory texts that are aimed to be published. We also touched on trade repositories, on surveillance and enforcement, and recently we've published on segregation and portability of client positions and collateral. There are 5 more papers that are going to be published. So as you can see, it's a very we're in consultation with the industry right now. We're very recognizant that we cannot diverge too much from what the US is doing, but we need to adapt it basically to the Canadian marketplace. So We're not taking a back seat, and I don't want this message to be the main goal of my intervention here, but we are looking, we're being informed is essentially what I'm trying to say.
You use the term relevant, and let me again give a little bit of a side story, but I spent about 4 or 5 years in Hong Kong. And when I was in Hong Kong, all of the people in the organization always used to come to me and tell me how busy they were, how active they were working all the time, and how hard they were working. And I would always ask them the question, well, what are you accomplishing? What results are you accomplishing? And they always had a great deal of difficulty with that question. So now I come back to a little bit of your comments and mixing it in with Michael and with Anthony for a minute. But we see this tremendous activity in the regulatory environment, whether it's regulators, whether it's legislatures, whether it's agency officials. And it strikes me as, well, I simply ask the question, what is it that they are trying to accomplish in all of this? And as I see all of this regulatory activity, what is the problem that they're trying to fix? And does all this regulatory activity actually accomplish any particular objective? Or is it designed just to keep the regulators busy and everyone else in the industry busy? So, Michael, let me throw that one back to you for a minute.
I'm sidestepping a little bit by saying this, but using Greece, a very current example. Greece has been in the EU now for 13, 14 years. I have never in all of those years heard any government say, don't buy Greek government bonds. The governments made the rules. The banks and the financial industry simply used the means that they were given by the various governments to conduct their business. All of a sudden, not all of a sudden, but over time, things got out of control. And out of control led to or leads to this flurry of activity. It's political parties, some of it is election bickering. Everybody is instrumentalizing the various crises on hand to demonstrate activity. Now, the underlying issue, I mean, there is some value to some of this regulation. I mean, things did get out of control to a certain degree. That's a fact. The question is, do you beat it until it's dead, or do you try to cure it in a way that it preserves the industry and preserves the marketplace? I'm not sure. The idea, of course, is to create more transparency. Now, are some of the measures being thought of or being taken, like deceleration of high-frequency trading? You know, I mean, do we get rid of pollution in the world by banning cars and everybody rides a horse again? I'm not sure if that's the right way of doing it. But things just got out of control on the one hand, and now the pendulum is swinging in the other direction just as radically. And that's where I have my reservations. A certain amount of regulation in a healthy doses, fine, but not this onslaught that we're facing. You know, bear in mind, firms like ABN AMRO, we have a whole bunch of lawyers and legal experts and all sorts of stuff, but we're not typical of the industry. The typical firm in the industry doesn't have a legal department. They use an outside legal counsel. They don't have their own IT department. They buy a lot of their technology. These firms are going to be in big trouble when it comes to implementing some of these rules because they simply don't understand. And if you don't understand, and if the punitive measures that you're faced with are very threatening, then you're going to take your hands off that stuff, leave it alone, or go someplace else. So that's my concern.
So what are you saying? Are you saying that it's only the big firms are going to be able to afford the compliance costs?
Well, they're the only. I think they're the only ones that are going to have a quote-unquote full understanding. Okay, now full understanding, it does not mean 100%. It may mean 10, 20, 30%, and it's going to take a long time for the industry to understand what all these implications are. But yes, I think, Fred, I think it's going to lead to a further concentration of business. I think small firms are in danger of being run out of business. And at the end of the day, you're going to have a concentration risk issue. You know, you're going to have, instead of maybe, 30, 40 big clearing firms, you may only have 5 or 10. And is that good for the business? I don't know.
Anthony?
Well, just to answer your point, no, it's okay, one of these. Absolutely right. It's not in anyone's interest to see concentration risks suddenly beginning to emerge, particularly when they take the contingent liability of the supporting clearinghouses. That's the last thing we want to see, to be honest with you, because one of the problems was all about this whole interlocking between so many institutions in smaller, big markets, which caused the domino theory, the domino effect. So that's one point. I think, to answer your question, Fred, I think there's a couple of things. One is we've been through a massive crisis, and there were clearly failures, not in all, but in some banks, particularly at the level of governance, understanding risk, and I think critically importantly, they just did not seem to respond to their responsibilities they owed to the system. So, the kind of question would be, what goes wrong with this product? How's it going to affect us and our shareholders? I doubt very few said, and what's this going to do to the system if it goes wrong? I bet you that wasn't asked in many boards. So there was a governance issue. Clearly that's right. I think in terms of what's happening now, regulators are driven partly by fear, partly by political pressures sitting around the whole box of regulatory repair. And I think you're quite right, transparency is a big driver, but so is compressing risk. And remember, risk is the oil that makes growth go. So we need to be careful about how much risk we compress. It's also about compressing innovation, I think, and it's driven by a sort of theology that says that we don't want this crisis like this to happen again. Now that's just ridiculously naive, because we all know, you don't have to go too far back in history to see crises usually sitting around credit risk happen about every 10 years, and it's just a question of how big they are or how small they are. And of course we're going global now, so they're always going to be bigger crises, let's face it. And therefore the issue for the regulators is not, can we stop this, because they can't. The issue is, can we, as I've used the phrase before, can we catch it on the orange light instead of the red light? Can we manage it? Can we mitigate it? Can we recover more quickly from it? That's what this whole program really should be about. My last worry is, we started off with a very focused approach on what we needed to do to cure the deficiencies that the crisis revealed. We've now got a massive program of regulatory repair, large chunks of which are really nothing to do with the crisis whatsoever. And we're now being bedeviled by a regulatory change program that the regulators can't do. The timetables are slipping. I'm not even convinced, with the best will in the world, that the regulators will be able to enforce what they're doing. Because remember, it's all very well writing rules. Somebody's got to supervise them. Someone's got to enforce them. So where are you going to get the staff to do all of that? And then on top of that, we're saying, let's go extraterritorial. I mean, this is just absurd. Sorry.
Michael, let me come back to you. This was a question that, there's Clive for an SASP this morning. And it's more the question of, okay, you're a big firm, you're a large multinational firm, you've got this large compliance staff, but as this world of OTC trading moves in the direction of exchange traded, or I should say cleared and counterparty guarantee, how are you ever going to make any money on this kind of business?
Good question. I don't know.
Well, let me rephrase it. Are you going to make any money on this kind of business?
That's another good question.
And you don't know the answer to that.
I don't know that either.
Does anybody know the answer to that?
I don't think so.
But I can tell you this. There are some big clearing firms that are completely recalibrating the value of clearing as a function that they perform. They're looking at the enhanced risk. They're looking at the limited amount of revenues that they're going to get out of this. And some of them may be saying, you know what, I can earn a better return on capital doing something else. Yep. Why would I want to go into this high-risk business of clearing if I don't get any revenue out of it that's commensurate with the risk I'm undertaking? And some of them are beginning to look very, very seriously at the risk-reward return of clearing. And that's the last thing we want. I mean, yeah, they should, but...
Right.
If I could, Fred, if I could add on to what Anthony is saying, I mean, clearing has become a volume business, okay? The margins have come down, I think, 20-fold in the last 10, 12 years. It's become a pennies game. And it's only worth, you know, it's only worth being in that business if you have the respective volumes. If, you know, for reasons that I've outlined, if those volumes shrink, then, you know, what used to be a small profit yesterday will be a substantial loss tomorrow. So if those volumes disappear, you're going to see the business shrink radically.
Let me switch topics for a minute to something you also brought up, Michael, and that's the topic of transaction taxes, because every year in the United States Congress, there's a bill to impose a transaction tax on the derivatives business. This is a big issue now in Europe, as I think everyone knows, with transaction taxes on transactions. But I mean, all of our traders, all of our market participants, as participants in the market, I think in every country in the world, pay taxes on the profits that they make. But this now appears to, I don't know if the underlying purpose is actually to generate revenue for the respective treasuries, or whether it's actually to penalize certain behavior that politicians don't necessarily like. So first, let me go to Canada. Do you have any kind of a transaction tax in Canada?
We don't, and to my knowledge, we're not looking into that as of now. So, as I said, we're in the process right now of just understanding what's going on. And maybe to Anthony's point, I cannot say that it's not a political push. And just for people to understand where a regulator comes from, historically speaking, the mission, anyway, of all regulators, Securities Commission, call them like you want, was to protect the small investor. The financial crisis, the ABCP, especially in Canada, and AMF in Quebec, for one, I guess just opened Pandora's box. There was, I guess, knowledge in there in saying, and I may be diverting from your question, but as I said, Canada, no tax, but regulation, and the purpose of it is not to refrain from the business, or we don't want to be, putting all those restraints in order of the business, but it's important for a regulator to understand what's going on. And I think that historically speaking, the focus is being pushed away from only the retail guy and protection to going into maintaining or preserving our market integrity. And to preserve market integrity, you need to understand where all of this is coming from, where it's going. And this is where in Canada, I don't think we've been very public, or I don't even think the thought has stopped yet on this is what we're going to do. There's a lot of discussions right now, and I think, anyway, in Canada, we're in the process of just understanding what's being done, how it's being done, who's doing it, and why. And then probably we'll come up with, I'm saying no for now. I'm saying no for now. I can't say no for the future.
But Anthony, you're closer to this than I think anyone. Can you just give us a little idea as to what's happening in Europe, and is the intent of some type of a tax to punish a certain kind of behavior?
Right. Well, first of all, let me say, using your power to impose taxes in order for punitive reasons is completely immoral. That's not the role of tax. It's to raise money for government spend. It's not. I'm not
imposing it.
No. So I just make the point.
Go ahead.
If the argument is to punish, then I think that's a completely immoral use of the power to tax. Now that's point one. Second point, in Europe, to answer your question, I mean, we've got 3 or 4 member states who are largely against it, and UK, Sweden, I think the Netherlands, but I can't be sure. Czech Republic, I think, is against it. I mean,
I think 9 have signed.
Yes.
And France is the
go
first
it
one
alone.
to go live in August.
Good luck to the French. Okay, that's
Good
fine.
luck.
We can live with that.
Yes, exactly.
So I think the position then is, I think the UK's position is pretty clear, that they've said publicly, look, we'll go, which I think is the US position, of course we'll do this if the rest of the world does it, and the knowledge that the rest of the world won't do it. So that's a pretty safe reason of saying no. So in effect, I think the US has sort of taken a fairly similar stance to this. So the reality is that the UK is going to fight this tooth and nail. I mean, practically, what's the reason? Because we'll end up by paying 60% of the tax and we'll get about 5% back. I mean, what kind of a death wish is that? So as far as the UK is concerned, very strongly resistant to it, but you're absolutely right. There may be a group of Eurozone countries that decide to do this, but I think if it was done for punitive reasons, I really do take offence at that. That's not the right use of the tax fiscal weapon.
So, Michael, is all of the European business going to flow to Canada?
Could be.
Ours won't. Here's Mike. Sorry.
No, but like I mentioned a couple of minutes earlier, we are seeing, not in a big way, but it's small things. Yeah, we see companies that are moving their offices, and you know, governments, not agencies in Canada, but governments, especially in Europe, they tend to think that a securities firm is bricks, cement, a building. BS is all I can say. I know one example, a customer of ours, very wealthy, he says, we're moving. In 6 months, we're relocating everybody. The entire team, families, pets, kids, everything over to Singapore. And now that's an extreme example. But we're also seeing firms that are renting space, among other places in Switzerland, as a hedge, whether it be a trading room, whether it be office space, whether it be setting up a second company in Switzerland or in another offshore location. They haven't activated it yet, but it's there, so if need be, they could basically move the operation on a weekend. And those are the types of things, you know, these are the first hints of a storm that worry me.
And in that sense, we're in exactly the same position because we're both regulated at the European level. So we both have the same issue about business migration. Whether it's penny packets of business or whether it's a major wholesale move, there is a real risk of that happening. And it's all very well for the US and the EU to talk glibly about we don't like regulatory arbitrage and therefore we're going to stop it. The result is west-east. It's a whole different ballgame.
Okay, well, let's pause here for just a minute and let me open it up for any questions that we might have from the audience. Anybody? Christian?
Well, I want to explain you something very strange in Romania. We are a member of the Christian Sima from Cybex Derivative Exchange in Romania. So we are a member of the European Union. We have our regulator who is nominated politically. Each party put a member there or nominated somebody, a person there. We have even something very curious that we have a member representing a party who disappeared 6 years ago. And our regulator put a huge tax before the tax that we are speaking now. And actually, until the 31st of December, until the end of 2011, my exchanges paid 22% of all the revenues to the regulator. 22%. Then I protest. I choose the way exactly like Michael, and I told I will relocate it in Switzerland tomorrow. I own a house there, so I put the stock market in the house. It's okay, because even like this, it will be cheaper. So I can understand that we can choose if we are trading a derivative, a stock, commodities on a market or on the other market as we wish. The client can choose the brokers, can choose countries where they made a transaction and so on. Why we cannot choose the regulators? Why? If everybody's shouting the MiFID, the dodd-frank, because I will explain, the Romanian regulator, member of the EU, we have to respect all the MiFID, but now they introduced even 2 points from the dodd-frank. They liked them. And they said, we put this inside. And being person nominated by a party, a political party, even their idea about this market, about the industry, is totally different. They didn't care about. So, if I am member of the European Union, why I cannot be regulated by, okay, I cannot understand that I cannot be regulated, but Mrs. Gallant, but I can be regulated in France, or in Germany, or by the FSA.
Well, Christian, I'm going to provide a partial answer to your question, and then I'll let Nathalie take a try at it. But in some cases, you actually can choose your regulator. I mean, there's an exchange in the United States called the Intercontinental Exchange. Their headquarters are in Atlanta. Their computers are in Chicago. But they're not regulated by the U.S. Commodity Futures Trading Commission because they had purchased one of the UK exchanges previously, and that's where their legal domicile is. So one of the issues I think that regulators face in these international linkages is, how am I going to regulate this activity? I mean, most of the exchange linkages are all designed around technology, but I would define any regulator anywhere in the world to show me where the central server is that matches all the transactions. When I was in Hong Kong, that was the biggest issue in Hong Kong, is the regulators wanted to, their position was that if this is where the trades match, this is where you're going to be regulated. But again, I would defy them to show me where that location actually is.
Our regulator is coming to see the servers. They want to see them. They want to see, so if you will arrive to the exchange, is a 14 tower of 14 floors, and we were forced to put video cameras of each floor. If somebody will climb on the building, the regulator can see them. I'm not kidding. It's like this, so we broadcast from outside the windows to the regulator in Bucharest exactly what's happened on the building. And everybody is put the questions. We finished even in television because all the video cameras are not pointed inside the building, but outside the building to see who is climbing on the wall.
Let me give you one other story, then I'll turn it over to Nathalie. Casaro will remember this. I'm in Bangkok in 2006, I think it was, doing some work for the stock exchange in Bangkok. And there's a coup in Bangkok where Thaksin was overthrown. And it was late at night, and my wife called me up and said, there's tanks rolling in the streets of Bangkok. Is everything okay? Well, I didn't know anything, but the next morning I went to the stock exchange, and there were all these tanks and soldiers with M16s guarding the front door of the stock exchange because they thought protesters were going to come and attack the stock exchange or something. Well, little did anyone know that the servers for the stock exchange are about 25 miles away, off in a different part of the country where no one could do any damage to them. But again, my point is that I don't, your regulators may well be an exception, but that seems to be the prevailing issue as to where the servers are located. But Nathalie, I'm going to start an exchange and put
something else. I'm trading the Dow Jones futures.
Yes.
I have an authorization from the Security Exchange Commission. I'm paying very small to the Chicago Mercantile Exchange, yes, but I'm paying 10 times more, 10 cents per contract, to the Romanian regulator, who told me that if it's happened in Romania that people are buying and selling, they have to charge me.
Okay. Nathalie, we're all going to move to Canada. Or we're all going to put our servers in Canada. Is that okay?
Well, the rules are being drafted. That's all I can say. I don't know what's going to be coming. I'm not sure if this is working. But to, I guess, follow on Fred's partial answer, in Canada, the way it works is we, as I said, we work on a harmonized principle, and the CSA essentially it says if you're doing business in Canada, depending on where you're offering the product, you can choose your principal regulator and then be exempt by the others. But it's just because in Canada we have protocols across Canada saying that we recognize our neighbor supervisory capacity and powers. Well, there you go. So, but this is on a pan-Canadian basis. So we talk to each other in Canada, and we exchange on the supervision and enforcement of all of this. But when we basically look into EU or the United States, we do have hurdles as regulators on supervision, and we do realize that regulation can either offer regulatory arbitrage or duplication. And with what's coming on the OTC derivatives, it's multiple. We're not talking duplication, only two here. Like wherever you want to deal, depending on where you'll have to report and who wants to see what, it will have an impact. So, you know, in the OTC world right now, on a bilateral basis, you have an ISDA agreement, basically that says you're not bound by jurisdiction boundaries, but you know, in Canada we call them electronic platforms. We don't call them CEFs. We don't call them whatever in the EU, but they're still to be defined. But when you're dealing on an electronic platform, this is where, okay, well, what happens? Which jurisdiction is going to be responsible for what? And depending on who's doing what, as regulators, who's going to be supervising and who's going to say, I'm okay with the way you're doing it. So that's how we're dealing with it.
I was going to ask one last question, whether all of this activity is actually good for the exchange community. But that, in fact, happens to be the topic of the next panel on the agenda. I'm getting the hook from the back of the room. So everyone, please thank our panelists for participating.